All right, let's do a end of day review for today. And today is Thursday, the fourth trading day of this week. And the market is really sell off today. But before we go to detail, let's review, the trade we took today. The very first trade we took is a real trade. Even though we did not succeed in the trade, but it provides a great lesson for us to add to our arsenal, to our experience. So next time we will do better. So that's our mindset right there. There's no failure, only lesson learned, right? That's the mindset we need to have in order to be success in the trading career. So basically, the real trade we take is right here, right? I did take a note. So before we go into rate, we saw that the London high is taken, right? And the buy side liquidity were rated. The sell side were rated on the daily time frame. So with that in mind, I thought that that's a great setup to go long. We saw the phenomenon before, so we can go long. And with that, bias, we kind of jump in the first, when we saw the setup right there, we came in at 9:36, and then 2 minutes later we got stopped out. So it's a successful trade because we saw the setup, we execute, and if it's not successful trade, then we stop out quick. So that's that can be a good feedback right there, right? You want your loss to be quick, fast, and you get out. But if your trade becomes a successful trade, a winning trade, then let it run. So that's the idea right there. So first, to see what the logic that we do, right? So right here, right? If we don't see anything, let's do like this. Let's do, let's do reverse engineer so we can see what really going on right at that moment, why we decide to go in. Okay, so in the real time, right, here's what I thinking at that moment, right? Okay, I saw this right here. Basically, I saw it make a lower high, right, which is a buy side of the keyword trap. So it's a lower high. So buy side of the keyword trap, right? Then boom, I saw it make another lower high, which is a buy side liquidity trap, and it come down, it take the sell side liquidity, right, which is what rated, which is our requirement to go long. Whenever in order to go long, the first thing we have to make sure that it have a sell side liquidity taken, and it did. So we're going at this candle, we go in at I think 36. I think we go in at the entry time first, right? Entry time for 0936. it's quite not a good time to enter. So next time we need to pay attention about the entry time. The time of interest for us, it should be 5. You want like this, right? You want 9, 10. I mean 10 minutes before and after an hour. So let's say it's gonna be if you want to go by 9:30, so it will be 9, right? 09:50 around that time, or 10 to 10, something like that. So that's an idea area. Or if you want to play on the turtle soup short, something like that, it will be around 30, right? That's the idea. I think 9:30, or some turtle soup settle like 10:30 or 11:30. So that's the idea. Okay, so yeah, when you see that, that's what we went in, and we didn't get it. The trade didn't play out as we expect, and so now look back at this. We do everything right. We have a sell-side liquidity rate, and before that we have a bunch of liquidity trap, right? Then now what lesson we learn? Why the trade is not, play out the way we want. Okay, so look carefully, right? And then now it starts going down. It starts going down. Oh, okay. So you see that right here, we already put right here a high time frame, so-called order block or resistance level right there, and we did take a note after that. We see that on the 1 hour time frame, right? Let's look at this screenshot that we took later, because we want to learn from our mistake, right? So that's how we improve, right? So we learn from unsuccessful trade, right? We learn the lesson. So basically, if we look at an giant candle right here, it's bullish breaker, right, or order block, boom, failure gap, then the whole thing right here, whole move up right here is just what? It's just a retest of this, bearish breaker right there, or in this case, I think a retest of the retest at order block. I think this annotation can be, yeah, you can see. I mean, it is kind of confluent with two setup, right? It is a bearish order block, and then failure gap and retest of this order block. Or you can treat this as swing low, then this down close candle become a what? A bearish breaker. So go back and test that bearish breaker. That's how we highlight this one. I think we did highlight earlier in the pre-market on the 15 minute time frame. Let's see that. Maybe not. Yeah, that's a different thing. Yeah, so the idea for us that we have to look at the time frame to see the setup. If the time frame give us some kind of bearish setup right there, then we better go with the high time frame. The high time frame can give us it's override. That's what I try to say right there. It's override. So that's the lesson we need to learn. basically we need the confirmation from the high time frame. So the lesson we learn is that lesson learn. Make sure, right, checking the confluence from the high time frame. Okay. So basically, if we engage a long right here, and you see it hit into this high time frame bearish breaker right there, then we have to let the bearish breaker on high time frame play it out, right? So if we engage right here, it's too early. You can see that it failed to break through. Whenever you see that it failed to break through, okay. There are also a scenario that it come up here and break through that. That's we have in our mind when we try. But next time just better wait, be patient. I don't know, for some reason this morning I just go in and take the very first trade, the real trade. I should have practiced this trade instead of going and boom. But anyway, that's the lesson we learned on that trade. And now move on to other trade that we saw the setup from. So we take one real trade and we lost 25 cents. So we good. That's a good lesson for 25 cents right there. Okay, then let's see this trade. Let's see what is this trade. It's a long setup. Oh, also we saw that also a long, because we saw this order block and fell up and this retest. That's how we were. But the entry time is 43. It's not a time of interest, and 43, right? And it's also an unsuccessful trade for us. We run right here, 43. Right here, boom, we got stop out. That's the second trade, right? Okay. Now the next setup is very good trade for us. So basically we have a swing high failure, right? We call swing high failure, and so we break down on M1. M1 is being 1 minute time frame. So just look at this. Okay, so go back here. You remember we go in and go long here, and we'll stop out. Then we look at it. Later on we see, just I don't know, or 10 minutes later, 43, right? We get lot also. Yeah, can you believe that? Oh, the trade that we were the second trade we go long here. Instead go long, we should go short. The reason we didn't go short, we have to look at here. So next time for us, we have to look both sides, right? If you have a thesis that we need to go long here, then look to see if we have the opposite thesis to go short. If both of them is present or coexist, then we should not take a trade, because that's 50% right there. We have to let the liquidity, we have to err on the side of precaution. Basically, when we see it, we're going to go long right here, but at the same time we saw a short setup right here, then let the short setup play it out. It did. You see it's auto block. You see the fair value gap right here, and retest right there. Even though you see all of this is what buy side liquidity trap, but it can trick at a what a failure, gives me fail swing high, or also called swing high failure right there. The reason why we erred on the short side because it hit into the high time frame, in this case, which is 1 hour time frame, bearish breaker right there. Let me visit that right here. I show you. We also go through that earlier right here, right? It hit into this bearish breaker on high time frame, so we have to error, or we have to give more probability, or give more weight on the short side, and exactly what happened. It going down. Look at that, it's going down. Let's look at that. Okay, and the target is on what, 5-minute time frame. So 50-minute time frame, right? So go here, the bearish breaker retest, then our target right here. This candle very important right there. It will revisit this auto block right there, and it is. That's the target for a short right there. And we will reach 20 cents and get $1.50 for this trade. So basically it's right here, right? We go in right here, retest right there, right? Let's say you go in right here and you put the stop loss right there. Yeah, about 27 cents right there. And your target under this level right there. Boom. Yeah, $1. 64 cents. Or it's go further down. Or it go right here. If you're not getting out, I mean, you still have a huge move down here. But let me see. Where is the 15 minutes? So our target gonna be 439, right? 439 something. Yeah, right here. It's basically 49. Yeah. So our target gonna be a little bit up here. Right there. Four. $429.8. I think that's the target. I mean the intermediate target right? But actually you let it run, it's run all the way to this level also. This called support level right there. And we get that is, yeah, this is what from the daily time frame. So this is a very quick trade for it right there. However, if you let it run, you see, man, that's a huge down move right there. So this setup is It's a huge potential for us. You can either exit here, take quick target, or you can let it run. You only reach that much, but look, if you let it run, how much you make? Let it run, look at that. You can make $1, 18, 17, or all the way here. You get what? $4.67. This is initial right there. But if let it run, the profit is $4.57 right there. Man, look at that right there. That's a beautiful trade there. Okay, so here the second practice trade that we saw on 1 minute time frame. Is a order block, long setup, right? Because we use a sell side liquidity right here, we rated, and then we saw that the buy side liquidity is still dropped here. Then we go long. That's fine. That's good right there, setup right there. But let's see how it turned out. The second entry, 10. So what the entry on this one? 10.06, right? Okay. So look at the chart, right? 10.06. So we go here, right? We thought it's auto block, right? And then fill up the retest, we go here. Or we say the second entry is 10.25. Yeah, we see this, the second entry, we call it retest again. But you know what? It go down and it take out. We take it out also. So this, okay, this stop loss we got stop out on this trade. So it make a requirement, but why stop it out? So the lesson we learn is right here. Also right here. Yes, make sure, and also I think another lesson we learn right here. I want to say that another lesson we learn right here is what? Pay attention to the overall trend, or in other words, you say environment. The same setup, but if you apply in a wrong environment or a wrong overall trend, it didn't work out. That's what we learned from today. We learned twice, right? This setup, we try to go long, and I think we also fell on this trade, right? I mean, all the long setup is a fail today. So the lesson learned is Okay, so basically we see that for the last couple of, last 2 weeks, the overall setup is that whenever it go up, it got sell off, go up, sell off. So that's the environment that I mentioned. So even though you saw this, the buy sell liquidity were trapped, right? Because it make a lower high, but that does not always mean that you can go in and long, because the environment is no longer a rally, it's no longer expansion at all, it's just distribution right there. So that's the note that we have to put in here, right? I think we need to do it's a case study for us. We will study more about this case study. We have to see that the expansion. So basically, in the expansion upside, any pullback, I change for it to go long. However, in the distribution down, right, expansion up versus distribution down, which is today and the last couple of days, distribution down. And when you see distribution down, you see that buy side liquidity quit check and the sell liquidity were trapped, but it could continue to go down. The minute it take the buy side, sell side liquidity, buy side liquidity here, it's gonna come down. We see a double top right here, and right into this auto block. Even when you don't see the buy side liquidity were taken, you see a swing high failure, you still short them. Look at the order block, because the environment already changed. It's become a distribution down, it's no longer expansion up. So that's the thing that we have to adopt, because our mindset, we have to remain flexible or nimble. We have to remain nimble. We have to recognize when is the environment that we are in. We trade in a market environment different, then we have to look at a different right there. Look at the way it moves different. We cannot just be so static and apply the same logic for two different environments. Basically, it's not gonna be one size fit all, right? If you want to go long, when you see sell side liquidity were taken, right here, then you make sure that it's in a expansion up environment. Okay, right here it's beautiful trade, right? You saw, oh, it's the sell side were taken, right? And all the buy side were trapped, and you go long. However, when it hit up here, it boom, going down. So if you go long, then you have to take a quick profit right there. Okay, so for the environment that change, distribution down, if you want to go long, you have to get profit out very quick, very fast. Otherwise you got to stop out and you get more frustrated, right? Because let's say you lost the trade right here already. You say, oh, it's a second chance for me to go long, and you let it, and right here you didn't take your profits because you say, oh, I won, one trade loss already, I want to let it run. Then boom, it go down, I take all your profit back, and then you lost second trade, and you get more frustrated. You see, and you keep going long right here, and look, boom, double chop, can get down, double top, you get down. So today market, it provides a huge lesson in terms of execution, right? So the trade is not only about entry or targets, stop loss. That's the mechanical of the trade. But the very first thing you have to be aware is the environment, where the market is going right now. It is trending or is in the ranging. Is it trending, then it's a distribution down or is expansion up, right? If it's expansion up, then it's okay to go in and long when the buy side liquidity was taken and the sell side liquidity was trapped. Sure, you can go along, you can go along all day long. But if you do the same setup there, but if in the environment already changed, the opposite happened, which is distribution down, and you go in whenever you saw a sell side liquidity were taken and buy side liquidity were trapped, you go in, go long, boom, you get stopped out right away, which exactly happened to us this morning. Right here, we go in, sell side liquidity taken, right? Buy strap, get in, boom, stop out. And we tried the second time right here, right? I think right here. Yeah, right here. No, right here. I think we tried a second time. 06. Yeah, 10:06 around here. Yeah, because it's a retest auto block, right? Sell were taken, right? This is buy side already taken. Right here we go long, or right here we go long, boom, it's go down, take sell again. Yeah, even though they already here buy side were dropped, but their environment already changed. The market is the algo already set up the program that it continues to go down and take buy side liquidity. So we have to let it run. Well, I think we have a couple of more trades right here, but I think we ran out of time. But one more thing I want to show real quick before we wrap up here. I want to show what is the 4-hour time frame. I mean, look at the 1 hour, right? You see 1, 2, 3 candle outflow right there. But you look at the 4 hour, it's a giant outflow candle. You see that, man? That's your 4-hour time frame. You see how big that candle is. It's a $4, $5 move right there. That I want to show real quick. And also one more thing that we are, look at this white move show down here, because they're an OPEC, right? Option expiration this Friday, and they say it's worth about 2.2 trillion. Maybe a lot of people buy call, right? Buy call, they want to expect the markets to go up. And the market maker who sells that call, they want this option to expire worthless, so they have to bring the market down. That's the reason why you see it's down huge right there. And that's the news that we need to pay attention, and we completely forgot about that. And that's our the lesson learned for it right there. Look here, you see I already bookmarked this for this year, so we can pay attention right here. The August 18, so basically the third Friday of every month. That's the OBAC day, which is option expiration right there, expiration. And you have every month the third Friday right there. But the super, they call it super one, is for every quarter. I think March, and then June, September is a huge big one, because every quarter the expiration is huge also. And then December, that's the quarter also. And they call triple right there, triple option expiration. So that's another thing I want to show real quick. Anyway, we over 4 minutes, over 6 minutes. Bye for now. Have a good evening and happy trading.